December 21st, 2023. Today we got a measured move down from bars 9 to bar 11 right here. Also, sorry I've been absent the past couple days. There will not be a review tomorrow either, but it'll be back to normal starting next week. I think next like Tuesday or Wednesday. But anyways, big gap up in bull bar on bar 1. But if you're buying one, you have to look at where you're buying. You're buying pretty much exactly a 50% correction of the big bear move. So it's not that great to be buying the close of 1 because you're buying 50% of a really strong bear correction. So you know that we're probably going to find some sellers there. Follow through for the bulls on 2, but this looks more like a channel than anything else. So you would think spike and then channel. So probably going to be a trading range pretty soon. Bar 3, pullback for the bulls. They're hoping that this is just a pullback in their channel. They're going to continue higher. Bears are hoping that this is, a channel and it's going to turn into a trading range, some sort of bear trend pretty soon. We get an inside bar on bar 4. Can you buy above 4? Not really. It's a high one for the bulls. They're hoping to get follow through, but it's really a triangle. So, inside bars are just triangles on lower time frames. And, it's an inside pattern too. So I believe, right? Yeah. So it's an inside pattern. So inside bar on 3 and an inside pattern on 4. Um, and when you get an II on the open, a lot of times, you'll get a pretty dramatic breakout to either direction, but I would rather wait for the breakout. And you can see on 4, you get bad follow through above the bar. So traders sell above 4 instead of buying above 4. And so you get a failed breakout to the upside, which makes 4 a reasonable swing, hoping to get a breakout to the downside, maybe even some sort of measure move down, like down here. We probably got a measure move of the bodies, but not of the tails. I assume. Yeah, we got exactly a measured move down of the bodies of the trading range that we were in. So since in a sense it's an II, it's basically again it's a triangle. So a lot of times when you get breakouts of triangles, you get measured moves down. I mean that's really what this is, right? This is just a triangle, and we got a measured move down the height of the triangle. If that makes sense. So basically, I think the same process is going on here with this II on 3 and 4. It's just a triangle on a lower time frame, and we got a measure move down to the triangle, and that's what we ended up. One of the reasons we ended up reversing here. But there were a couple other reasons that I thought were important. But anyways, you can sell below 4 or sell below 5 if you want to for a swing. I don't know if you got 2 to 1. You definitely got 2 to 1 of your true risk. You definitely got 2 to 1 of your actual risk. Okay, or the full risk. Follow through on 6, follow through on 7, but there are tails on, big tail on 7, small tail on the bottom of 6. So while you can't be selling, it's maybe not as great as it could be. And then 8, if you look at it, it breaks out below the channel line. So you essentially have a channel line being created here. And then 8's a steep breakout below the channel. When you get a breakout below a channel, there's really only like a 25% chance that you're going to get strong, successful breakout. Might be a little higher in this case, but I looked at this as a channel line break. And a lot of times here, when you get a channel line break, it's forming the bottom of a trading range, and you're going to end up getting a reversal up. Keeping in mind we are at the measured move as well. And I thought what else was important was that if you sold below 5, like here, you look what you were able to make. You were able to make pretty much exactly 10 points, right? A little more than 10 points. And if you sold below 7, which was another reasonable sell, you could have sold below this, or you could have sold below that. You could have sold this close too, but if you sold below 7, you're able to make a pretty quick 5-point scalp. So traders who sold here make 10 points. Traders who sold here make 5 points. It's a climactic channel line break, and it's at a measured move down. A lot of reasons why we're probably going to end up getting some profit taking here. And if you're in a spot where you think you're going to get a lot of profit taking, it's okay to take at least half of your position off and look to add it back on lower. So that's what profit taking is what causes bar 9, and it's a trading range, right? So in trading ranges, a lot of times traders are gonna traders are gonna exit pretty quickly, and it'll cause like large rallies like this bar, or large sell-offs like 12. So risk happens really fast in trading ranges. And with bar 9, it gets to about a 50% correction or closes at about a 50% correction of the bear move. So if you're buying the close of bar 9, you're buying right where there's going to be bears looking to sell. And something else I thought was interesting was if you bought below this low, or sorry, if you bought a 50% correction of bar 9, since traders were selling the 50% correction here, which was causing this, if you bought the 50% correction of bar 9, it almost filled you exactly. And if you did that, you were able to make pretty much exactly a 5-point scalp around the high of exactly a 5-point scalp at the high of bar 9. So what that means is the traders who bought this 50% correction were able to make exactly 5 points here. So it's not all that great to be buying above 9, because you're buying where a lot of traders who are scalpers buying this correction are going to be selling. They know this is probably a minor reversal. They're not expecting it to go all day. So a lot of them are going to be taking profits. 10, follow through for the bulls, but it's really not all that great. There's a big tail on the top, and then you get a surprise bar on 11. But, the same way that this clearly became always in short, probably on bar 8, this is clearly becoming always in long on bar 11. But it's a trading range day so far. So, do you really think this is going to be just a massive bull trend after we just had 6 straight bear bars? Probably not. It's probably going to end up being more sideways. So this bar is, more of a, I'd be really cautious buying this close. Or you at least want to buy above the bar if you're going to do that, because you can see a lot of times these climaxes, the final climax doesn't trigger. But I still think it's better to look to, not really buy up here and not really sell down here. These are profit taking areas. And that's what happens on 12. A lot of traders take quick profits when we get this rally up. And that's what causes the big bar on 12. 13 is a high one for the bulls. They're looking for essentially a spike, a pullback, and a channel up. But it's such a big move down on 12 that it's good enough for a second leg. And it's probably not a very good argument for the bulls. It's also the middle of an overall trading range. So it's really not all that great to be buying. That's why you get bad follow through on 14. Probably more traders buying below 13 than above it. But even that, really not all that great of an idea. 15, it's a double bottom for the bulls. But if you're buying above 15, you're buying the top of a tight trading range. So really not all that likely that you're going to get good follow through. And additionally, if you bought above 13, how do you feel about 14? Not all that great. So, right above 15 is going to give you a chance to get out of break even. And a lot of traders are probably just going to take that chance to get out of break even and exit. And that's what's happening on 16. So traders, they buy above 13, they probably scale on lower, and they exit above, essentially right above 15, which is around their break even during 13. So not that great to be buying above 15. Double top, 16. Can you sell 16? It's a little higher in the tight trading range, so it's probably better than buying above 15, but it's really not all that great. You're probably selling, hoping for a second leg down from 12, but it could be pretty brief. We're probably going to test this close. For the same reason we might, probably also going to test this close, is that it was reasonable to sell this close. It wasn't great, but it was reasonable. And so the traders who scale in and looking to get out around their first entry, break even at their second entry with a profit, are probably going to make money. And the same thing happened here. Traders bought this close and they scaled all the way in, and they were able to make money later in the day. 18, it's 3 pushes down, 1, pullback 2, pullback 3. I thought 18 was a reasonable buy. You are buying right on the moving average, but it's reasonable for at least a scalp. And we didn't end up actually really getting very far. We essentially just tested back into the tight trading range from 13 to 16. And I thought traders who bought above 18 were going to do a little bit better than that. But you can see what happened is they only made about 3 points. And then they got disappointing follow through on 19, not closing very strong. And when they got that, a lot of those traders just exited. And that's what causes the micro gap down and the sell off on 20. Traders just exiting. And bad follow through for the traders who sold below 20 on 21. You wouldn't want to sell below 20. So bears are hoping it's a channel. Essentially, 12 is the spike, and now we're in a channel for the bears. But it's not a very strong channel. It's looking more like a wedge than a channel. 21, it's a bull reversal, but it's right on the moving average. So do you really want to buy above 21? No. What do traders want to do? They want to buy below 21. It seems like a much better idea because you're not buying right on the moving average, but this was a relatively decent buy, so it'll probably end up getting tested. This close will probably end up getting tested too and head back into this tight trading range. So if you're buying below 21, you're buying the bottom of a trading range below a good signal bar. And additionally, if you're buying below 21, you're buying essentially around the 8 close. And bears who sold the close of 8 are disappointed. Obviously, they're disappointed in how 9, 10, 11 looked. So they're going to be getting out around break even 2 during 22. You can see that's what was happening, and that's what caused this buying. So it's a big mistake to buy above 21 and just put a stop below 21. If you're buying above 21, you probably have to have a stop at least below 9. Follow through for the bulls on 23. A good bull bar, but you're still right on the moving average and you're still in a pretty tight trading range. So things, risk can happen pretty fast. And you get follow through on 24 for the bulls. But now, what's your 1-to-1? It's essentially, this is not as good of a representation. I think the actual 1-to-1 is right around the high of bar 11. And what are the odds that we're going to race right up to the high of bar 11 before we get below here? Probably not 60%, probably pretty close to 50-50. Maybe it's, a little bit of an edge for the bulls, but I don't think it's quite 60% that we're going to get up here before we get, down here on the close of this bar. So that's why you end up getting bad follow through on 25. Sometimes they'll buy it and you'll get a vacuum up, but this wasn't one of those times because the risk was getting big and you're in at the middle of a trading range now. And that's why the traders don't buy in the middle of trading ranges because the math is bad. 2026 essentially tests up. Bulls who got above 24, just 0.25, are exiting during 26, and more bad follow through on 27. Again, just traders exiting. 28, a bull bar, but not very strong. And then you get disappointment on 29. Can you sell below 29? This whole thing is a triangle. You probably can take it for a swing, but I was kind of just waiting for a breakout at this point. It's a reasonable thing to do to put stops, a stop order here to enter short and a stop order here to enter long at the top and the bottom of the trading range, because a lot of times when the range contracts like this for so long, you end up getting a pretty reasonable breakout. And I thought that was the case today. It was okay to do that. I assume we got to on that vacuum test at least a 50% correction of these. Yeah, that's interesting. So this was pretty much the first reasonable sell signal bar. I suppose you could say this was as well, but we didn't quite get there. But I thought it was interesting that if you sold below this, if you sold this close and you waited for a good sell signal bar, this, and you sold there, basically right around your break even price was where we started to go sideways. Bears got follow through on 29, but it didn't quite close below the low of the trading range. But I still think it's okay to sell the close of 29, or sorry, sell the close of 30. So they got follow through on 30 from 29. And I still think it's okay to sell the close of 30. You're trying to get a breakout below the low of the trading range. And then you get a big follow through bar on 31. And 31 got a little too big and a little too climactic. So if you were short, if you sold the close of 30, you were able to make almost exactly 10 points on 31 in 5 minutes. That's a pretty big profit for 5 minutes. So a lot of those traders started to take profits, and that's what caused this tail. And even if you sold the close of 30, you didn't get filled till right here. So on 32, those traders were able to make exactly 10 points. So that's why we started to go sideways, and you get bad follow through on 33. Still reasonable to be short. Disappointment on 34, and then a bull bar 35. And, I think traders probably would have exited above 35, which is why bears sold the close of 35, hoping it wouldn't trigger on 36, and it didn't. And then you get a disappointing, basically a big disappointment bar on 37 for the bears, sorry. So bears who were short were hoping that this was going to essentially be a spike and then a channel, but this is pretty climactic. It is a triangle and a breakout below a triangle, but it's overall pretty climactic, and traders were hoping to get down here. But essentially, this traded above the high of the channel. So if you had a stop above the top of the channel, you got stopped out, but the bull closed, so traders don't want to sell below it. Disappointing follow through 38, 39. 40 is a second leg. So, or, you could look at it as a wedge pullback, 1 pullback, 2 pullback, 3. So it's some sort of micro wedge, or you could look at it as a 2-legged correction from this, and you could sell below 40 looking for a second leg down, and you get good follow through on 41. So you could probably sell below 41 as well, and you could sell the breakout. And if you're doing those things, what are you hoping for, right? You're hoping that we continue down strongly, and you're looking for this to get a good second leg. And then you get 42. It's a midday reversal. You could say it's 1 push down, pull back, second push, pull back, third push. So suddenly this might be a third push down in a trading range. And so traders are pretty eager to get out, and a lot of them get out at the market. They'll sell again if we get a strong bear bar, or they get out above 42, and that's what drives the market up so fast on 43. 44, an inside bar. 45, failed breakout above the inside bar, so failed breakout for the bulls, and a reversal down. It's essentially a wedge. You're still selling in the middle of a tight trading range. So, as an always in trader, I wasn't too sure what to do in this area. I sold the close of 30, and then I exited a lot of it on the close of 31 and thought I could re-enter on the close of 32, since I knew it wasn't going to be as good, because we were probably going to get a pullback. So I think the correct play, I exited on the close of 31 because I thought we might get a good reversal up, like a big bounce, because a lot of times when you get a big bar, you get a lot of profit taking, like exactly what happened here. So what my plan was to exit on the close of 31, and if we start to channel down, I'll re-enter. And I did re-enter, but I made a mistake and I got stopped out above 32. I think I should have had a wider stop than that. I just thought it was the top of the channel, but I should have waited for a close below here, because we didn't end up getting the close below the bottom of the channel. We only ended up trading below it, but I should have just kept a wider stop and basically sat through most of this, and probably can exit above 42. And then I would say you can sell again below 45, but then when you get 46, it's a pretty climactic bar right to the bottom of a channel line that the market has pretty obviously been paying attention to all day. We've hit it a couple of times. So I thought that you could do the exact same thing on 46 that I did on 30, which is flatten at the market when you get the big climactic bar. And then if you get, just something like this, you can re-enter hoping it's a channel. But instead we got this. So I thought that I could have treated 46 the same way I treated 31. And if I had, I would have done better. Uh, Big bull bar 47 and follow through for the bulls on 48, but not all that good. The risk is huge, right? So if you're buying up here, you're a really huge risk. So it's not exactly what you want it to be. Um, Anyways, bad follow through 49, and then disappointment on 50. Can you sell below 49? I don't think so. I think it's, one second, I'm gonna pause this for a second. As I was saying, the risk is really big on 48. You can maybe put a stop below 48, but I don't think it's all that good of an idea. Arguing that essentially this is a channel, that if you're buying above 48, you're hoping this is a channel and this is the bottom of the channel. But I don't really think that's all that great of an idea. Follow through for the bears, bulls on 49 is poor. I wouldn't sell below 49. You get bad follow through 50, 51. Once bears who sold below 49 see 51, they're probably going to exit around break even, or just at the market, really, and that's what's causing 52. It's essentially an expanding triangle. Traders are hoping it's an expanding triangle, and that we're going to get a reversal down, but when we're not getting it, traders start to think it's probably more of a channel, which is what it was. Follow through for the bulls on 53, but big tail 52, 53, and 54 could be parabolic wedge on a smaller time frame, 52, 53, 54. And are you going to buy above 54? I wouldn't. I think that you're waiting to buy a pullback at this point because it's probably a channel. And do you want to buy the tops of channels? No, you want to buy the bottoms of channels. So it's really not that great to be buying up here. You really want to be buying like a 50% pullback or something, somewhere in here. This is a much better area to buy. And you can see that's one of the reasons you get disappointing follow through on 55. And the traders who do buy above 54 are disappointed in 55, and they're getting it around break even during 56. 57, a bear bar, but not really all that great. I think it's 3 straight bear bars, and in theory solid close, but it's really not that great. You're right at the bottom of a bull channel, and that's why you get something like 58. Traders know it's not all that good, and there's a lack of bears willing to sell because they're selling right on the moving average on the bottom of bear channel. So it's really not a great idea. And then you get a huge bull bar on 58. But what are bulls going to do with 58? Well, we just got 3 bear bars, so that's kind of disappointing. You generally don't want to see 3 in a row if you're arguing this is a bull trend, but it could still be a bull channel. So the traders, you can see what they did the last time we broke out to the top of the channel. They sold it and they bought the pullback. So what are they going to do here? They're going to sell it and they're going to look to buy a pullback. And when you get 59, if you're selling 59, you're selling right where that traders who sold, any of these closes really are going to be pretty eager to get out around break even because they're disappointed in 58. So 59, really not a good sell, and you're still selling on that channel line. So what are traders going to do? Well, they're going to buy below this bar, and they're going to be buying down here rather than up here, and they're going to be buying down here rather than up here. Then you get a bull bar on 60, maybe an okay buy, but you're still buying higher than you'd like to. And when you get follow through on 61, it's not surprising that the breakout above 58 fails on 62 with a bear close, because you're buying at the top of the channel. 63, essentially a second leg up from 60 and 61, and then a failed breakout to the upside on 64 and a reverse down. I wouldn't really, you could sell 64. You're towards the top of the channel, so it's probably an okay sell, and you probably have enough room here, that you might not get trapped, and you'll have enough time to see how it looks before you need to get out. But you still have to be pretty quick to get out if you're selling below 64. You could argue it's a spike and then pullback, and then 1 pullback, 2 pullback, 3. So you could argue it's essentially a spike and then 3 pushes up, and you're selling to get towards the bottom of the channel, essentially somewhere down here. And I assume your risk reward is relatively decent, almost exactly 2 to 1 to the bottom of the channel. And then you get bad follow through on 65. And then 66, a good bar, but it ends up being disappointing. And what does the big tail on 66 tell you? It should tell you that traders are scalping out. So the bears, not quite able to make 5 points. They only made 4-ish points, and then they scalped out. And we officially touched essentially the low of 57 because some traders sold this tick or that tick, and they're pretty eager to get it as well. And you're testing the bottom of this buy climax. So really not all that great for traders to be looking to sell. 67 trades above 66, so it's 1 pullback 2, so it's essentially 2 legs down, and it is a channel line break. So bears are hoping that we're essentially going to get a channel line break. And then once you see this, they're thinking that we're going to get a pullback. So they're seeing 69 as a pullback, and they're hoping for some sort of double top and a major trend reversal, maybe all the way down here, because now you have a channel line break, and this second reversal could be a major one. But instead, you get follow through on 70, and it's back to buy the close. Do you buy the close at 70? Um, you probably can. There's a reasonable enough chance you start to get a test up. But the thing is, if you buy the close of 70, you need pretty quick follow through. Or the close of 71, you need pretty quick follow through. You don't really want, to be trading below anything or any deep pullbacks here, because this is, it's just relatively delicate. It's lower probability, and you need pretty quick follow through. And if you don't get it, you need to get out. So then you get a huge climactic bull bar on 72, which essentially erases the edge. Bulls who are buying, here or whatever, they're looking to get back to this close because they know that this is a magnet, since some bulls technically bought the close of 11 and they were disappointed in 12 and they never had a chance to get out of break even. And it's a trading range day clearly at this point, so they should. And so that's what's happening here is we're getting a vacuum test of that close. And you can see once we touched it, we did find some selling. On the daily chart, good reversal bar for the bulls, but this was a huge bear bar, and it did enough damage that I definitely think the bears who sold this close are going to get out at break even. I also think that once we start getting back up to, above this bar, we're going to find sellers. So we'll probably end up with a higher high here. It's reasonable to think we're going to get above this high, but I think once we do, we're going to fail and get a failed breakout. The weekly chart, we're entering some of the last weeks of the year. I don't even know what trading days there are next week. I assume it's not, well, obviously not Monday. I think we're trading on Tuesday, but obviously New Year's Day is off, and I don't know exactly when that is. Okay, so there's trading pretty much for at least 3 days next week, and then no trading the following Monday. But I wouldn't be surprised. It'll be interesting to see if this ends up being a bull close tomorrow. Traders are going to be fighting over the open of the week. Bears want a bear close so they can, get their first bear close in 7 weeks, and bulls want another bull close so they can still argue bull micro channel. And yeah, that's the day.